This is Larry Williams, and I think the bull is going to come back to Wall Street. I'd like to explain to you why I feel that way based on indicators and my understanding and trading of the markets for almost 60 years now. So the bull is back, but why? Why would I be so bullish at a time of pestilence and famine and plague? Well, bear markets never end on good news. I've seen a lot of bear markets end in my life going all the way back to 1962. The news has always been very bearish at the bottom, and it's always been very bullish at the top. The other important point here is that we're probably going to have some tough sledding in the economy based on the coronavirus, but markets bottom before the economy turns around, probably about 90% of the time. Uh, the stock market seems to anticipate in advance what the economy is going to do, just like the market started to fall apart a month and a half ago, and now we know why. So the market is a leading indicator. So I don't look for a great economy to tell me that the market is bottom. When prices are at severe discounts, though, that's a great sign that the markets have bottomed. When dividend yields are very, very high on the Dow Jones Industrial Average, we're at a market bottom because big money will come in saying, wow, prices are way undervalued. So value is important. But the most important of them all, I think, is panic selling. I'm going to show you examples of panic selling going way back to the 1930s. And what I've noticed in my research in the markets is that when we see an excessive amount of pessimism, if you will, or panic selling, markets just flat out bottom. They may not bottom right that instant, but they're in the area below. And often, as you'll see, these panic indicators I've developed do call the market to the week of the low. About 65% of the time, my panic indicator has been correct to the week of the low. So it's important. It does tell me as a longer term investor that I need to shift gears. I don't need to rush in and buy stocks just today because we've got a panic indicator buy, and we do. And I'm going to show that to you. It tells me, though, that I have to change my frame of reference, and I cannot get carried away by the media mongrels' bearishness who are just fasting away here on raw meat about how bad things they are. They didn't tell us that a couple months ago, and they're always regurgitating what's happening now, not what's going to happen in the future. And as a trader, as an investor, my concern has got to be the future. So how can we identify panic selling? I'd like to teach that to you today. Panic selling is caused by what I call capitulation. People just throw up their stocks, just get me out. And the last couple of weeks has been really interesting to me to see my neighbors and friends say, oh, I'm selling. I'm going to sell everything. I'm never getting back on the market again. That's how market bottoms are made. So capitulation causes something. It causes large ranges in the market. Now, if you know anything about the market, if you're alive on any place in the world, you know we've seen large ranges, very big days. We've seen, it's very interesting. In the crash of 1987, we saw the market move. The value of the market then was about 2,000. We saw the market move one day, 2,000 points. So we moved in one day what used to be the value of the Dow Jones Industrial Average. That tells you we've seen a lot of volatility. You've probably heard about the volatility, which means we've seen large ranges. So excessive selling or panic causes people to throw up their positions, and that creates large ranges in the marketplace. And we can use that as an indicator. So come with me now, all the way back to 1934. The red line that you see here at the bottom of your chart is simply a front end weighted moving average of the average weekly range. That's no magic to this. We're just looking when ranges are very high. And notice when ranges are very high, we're in the area of a buy point. If markets have been declining, if they decline on large ranges, look at the buy points a little early in 1942, but had you bought there, boy, you were certainly rewarded, weren't you? So what we've seen is excessive ranges created by selling. Now notice here we had an excessively high range. The moving average of range was very high, but was caused on a big gap up, some pre-war news, and the market immediately sold off. So to really understand range expansion, you want to see large ranges expand as markets are moving down. Let me show you some more examples. Excuse me. Here's large range examples in 1958 to 1968. Again, the red line shows we've just seen a lot of large weekly ranges in the market. Bingo, at the low. In 1962, about a week from the low, large range expansions and another big bull market begins. 1966, we also see the same thing. Market comes down, we see large range expansions, and the market moves back to the upside. So one way that we can actually measure and look at what people are really doing in the market is just a simple moving average of ranges, because ranges tell us when people are panicking. Well, we can look at 1968, but let's come forward in time and look at 1984 to 1995. Remember what I told you, if a market is rallying up and we see range expansions, that can actually be bullish. What we're looking for is when markets decline rapidly on range expansions the week of the low in 1987. In 1989, we also saw the market dip a bit, large range expansion, market low. And in 1990, right at the market bottom, we saw large range expansions. In other words, there was a huge amount of panic in the marketplace. People were selling, just not even thinking about the position, just liquidating them, a market bottom. In 1994, we saw the same thing, a very sharp break in the market, about what we've seen now, about 7-8 weeks in the market. Range expansions picked up to the upside and the beginning of another bull market. If we look at the 2002 to 2010 period, we see the low in 2002. Markets coming down, large range expansion. It didn't call the exact low this time. Nothing's perfect in this business. If you want perfection, you should not be a trader or an investor. However, had you purchased at the range expansion in this area, prices went higher. We started a bull market. We came back and continued that large range expansion and did make the absolute low of the marketplace. In 2006, the market broke for a little bit, a couple of months. Things looked really bad. Large range panic selling, and away went the market. In 2008 was a bit premature, large range expansion on the way down. Had you bought there, you had to wait about 7 months before you're profitable, but you were profitable. Large range expansions are seen at market lows. So you're probably wondering, what about now? What do large ranges look like right here, right now? I'd like to show you. This is a large range expansion from 2011. The market had been coming down, large range expansion, a wonderful buying opportunity. In 2018, we saw large range expansions, but on the upside, doesn't mean much. In 2019, at the end of 2018, the first of 2019, large range expansions. Again, the Cassandras had come out of the woodwork and saying it was all over, that the market was crashed, a depression was coming. Large range expansions showed us that people were panicking. They'd listened to the purveyors of pessimism and they sold their stock, and we had a huge bull market rally. So right here, right now, here is the range expansion from currently. Look where the range expansion is, very high level. This is a level where we've seen bull markets start. So we know, absolutely speaking, that we have seen a huge amount of selling this market, panic selling, and we're at the point that I think the bull is back. You can look at this in another way as too. I'm going to show you my favorite indicator in a moment, but I want to combine a couple of things. We can look at large range expansion. We can also look at volume. That represents actual buying and selling. Again, going back to 1937, look at massive amounts of buying, massive amounts of selling as buyers are getting out of the market, market bottom. 1940, market bottom. 1942, market bottom. We can see a measure of volume as well. Here's 2006 to 2013. Huge amount of volume on this down move, and the down move over here, buying opportunities. 2008, 2010, massive amount of volume, the highest volume we've seen for a couple of years, market low. In 2011, largest volume we'd seen for a couple, 3 years again, market low. So volume can also be used as an indicator to tell us when people are panicking, when they're really liquidating their stocks, just selling, just get me out. I recall one day a broker friend of mine during one of these crash periods called and said, gee, I got an interesting call today. And one of my clients called and said, get me out, sell them. And I said, well, what? Because he had a whole bunch of positions. And I said, I don't know, just sell them. That's how panicky people can get at market lows. And this is where volume is now in 2020. The last big upsurge in volume on a decline we saw was in 2015, market low. Remember that low point I talked to you about at the end of 2000, uh, 18, the start of 2019, when we saw a large range expansion in the marketplace. We also saw it was backed by volume, large volume, 1 week from the absolute low of the marketplace. And here we are again, large volume, the largest volume we've seen. So that to me tells us people are in a panic mode here, not just a little bit of panic mode, but an extreme panic mode. And that's what I like to see as a sign of a market bottom. When people just liquidate everything, they're panicking and markets bottom because as they panic, think about this now, as they panic, they sell everything and that drives prices down so much that prices are at a discount. Prices are at a value level. So informed money, smart money comes in and says, hey, they're running a sale at the market right now. I'm going to buy stocks. I'm not going to buy toilet paper. I'm going to buy stocks because they've seen a discount because people have just capitulated in the marketplace. Another thing I'd like to show you is this ain't my first rodeo, guys. I used to ride rodeo. I can tell you a little bit about the first and the last ride. And this is not our first rodeo with this particular price pattern. Let me show you what I mean by that. If you look at prices in 2000, this is the blue line you see from Timing Solutions, is the absolute exactly what happened in 2000. We had a very similar decline, bottom about this time period, ran up and came down. So this is the year 2000, just put over the current price action called the price analog. That's 2000. We can look at 2007, very similar. The market moved up, broke sharply. And 2007, this was in the blue line down here, market rallied just about like we saw, broke sharply, and put in a low point. If we add together 1994, 2000, 2001, 2003, 4, 8, 9, we can get a similar year. In other words, all these years averaged together create this blue line. And they present a really interesting line down here, don't they? They generally tell us this is about what we can expect. Now, this is why I think this might work. By and large, I'm not a big fan of these analogs, but when I see that a bunch of them have the same pattern, it tells me that the cycles in today's market, the black line that you see, are probably similar to the active and dominant cycles that we saw back in those markets back in 1994. This also looks a lot like 1987. So the driving cyclical force, I think, are about the same ones that we were using and looking at back then. With that in mind, we can take that information and perhaps make some cyclical forecasts. And in any event, we see that generally speaking, we've seen this pattern before. This is not our first rodeo. And usually with this pattern, we start to bottom about now. Time for the bull to come back. I also think fundamentals really matter in the marketplace. There's a strong relationship between interest rate futures, energy costs, the dollar index, gold, all these things really relate to how the market performs. So the chart I'm really pleased to show you right now is my crude oil forecast. The blue line represents crude oil prices pushed forward into time. And as you can see that what happens in crude oil usually then happens later in the stock market. Decline, big rally, break, and the crude oil forecast suggests we can start to rally in here and should see prices come higher. This is using a weekly chart and a weekly extension of crude oil prices, how they actually influence stock prices. There's a lot of correlation here. Now, big question. Do we have correlation here or do we have causation? Now, I really don't know for sure, but it strikes me, if you think about it, could energy prices affect business? Could business affect the stock market? Well, obviously, the answer is yes, that there's a high correlation of the cost of energy and what goes on in the world of commerce. So I believe that if we find correlation, as we found here, that we can also find causation or believe that there's causation to it. Clearly, what happens in the energy markets does have a strong influence on business, and what happens in business has a strong influence on Wall Street, on stock prices. So what I like to see is a combination of things coming together here. We saw, oh, we have similar patterns from the past, not our first rodeo. We have excessive panic selling in here. We see that by the weekly volume numbers, or if we look at just the average ranges. So There's a lot of stuff. I don't want to get bullish just because one thing happens. I like to see a lot of things happen, like the difference or the correlation between interest rates and the stock market. The chart you're seeing now is a blue line representing Fed funds and the effect the Fed funds have on stock prices. I first showed this to our subscribers a couple of months ago on my weekly market commentary, Larry TV. So we've been watching this for quite some time. And it suggests that we can have a bit of a bounce in here now, but probably around the middle of April, the interest rate markets tell us that we can expect a really nice stock market rally, which tells me that certainly by then, as a long-term investor, I'd like to have my long positions locked up and know exactly what I'm going to be doing and get ready for the bull move because, as I said, I think the bull is back. There's been a strong relationship between interest rates and their ability to predict the stock market, especially Fed funds. You can see in the chart, it's really nice to have a roadmap to know now what we should expect in the future. The trouble with most people and why they panic right now, they don't have any sense of the future. All they see is right now, stocks are down 1,000 points, sell. They don't have a view of the future. I think having a view of the future gives us perspective. And it doesn't matter what you do or where you are. If you have perspective of something, you have a much better view, a much better understanding of how to handle what you're doing now because you have a glimpse of the future. Now, clearly, let me go on record. We don't have a perfect view of the future. The market won't move exactly like this little blue line, but it'll move pretty close to it, which gives us enough to have perspective, to have some faith and some hope because we can see most likely what's in store for this market. We have perspective. Perspective is so important. Most people get a buy signal, a technical buy signal in the market, but they don't have any context to it. Buy signal bull market, buy signal bearish conditions, bullish condition. So they can't really take advantage of a short-term technical buy signal simply because of a lack of perspective. So here's my panic indicator. I'd like to share with you the panic indicator. This is an indicator I developed years ago, many years ago, and it's done an excellent job of calling some market lows. Here is the buy signals at cave in 2002, a little bit before the low, the week of the low. In 2008, a little bit before the low, then the week of the low. These are some of the worst signals, by the way, that we've seen in the indicator. And this is where we are now. Frequently, like 1966, it gave us buy signal the week of the low, 1962, the week of the low, 1970, the week of the low. A lot of times it's nailed, like I said, the week of the low, 66% of the time it's been within 3 weeks of the absolute end of the bear market. That's an amazing indicator. What an amazing record to be able to do that. And here we are now. We've seen 3 signals going way back to 2011. The week of the low in 2011, the week of the low in 2018, just as 2019 started, and Friday of this week, we got our signal. My Williams Panic Index went into the buy zone. That's the green line that you see up here, right? We have to see that much panic. When we've seen that much panic, that much range expansion, that much volume, that much just rampant selling in the marketplace, it tells us we're probably bottomed in the market and probably the bull is back on Wall Street. Now, you're not going to notice that in a hurry because the bull's going to wander around here for a little bit, go back and forth. The market has to put in a bottom. It usually does that by running up, coming back down, kind of like what we saw on the slide back here. Typically, markets will run up, they make a double bottom, might be higher, might be even lower, but this is probably the area when we're going to see that double bottom form. The market should start to rally, pull back, and then the big move begins. So we probably have some time in here. So that's the perspective, and that's the buy signal from my panic indicator. Well, something really got crushed in the recent market, and that's the price of gold. And it really crushed an old wives' tale. When stocks decline, gold will rally. I have been preaching for the last 30 years, that just ain't so. And the gold bugs always go crazy. Oh, it gotta be. Well, look at the record. Don't take my word for any of this. Just look at what happens to the price of gold when stocks decline. This is where we are right now. Gold, massive decline in the market, right along with stock market. Wow, what a surprise. This is not an anomaly. If you go back and look what happened to stocks in 2008 or in 1970 or in 2002 and 3 or all the way back to the Depression, you'll see that when stocks get really beat up, gold also declines. And here's why. Because we could call it a depression, a recession, whatever you want to call it. But when everything goes down, when the stock markets go down, everything goes down because people are depressed. They sell everything. The gold bugs don't even hold on, do they? We see that. And what I have noticed is in these massive sell-offs, the only stocks that really go up really well are alcohol stocks, Diageo, companies like that that make booze. They tend to do pretty well in times of depression, and soap stocks. But short of that, the energy markets are the precious metal markets have really fallen apart. I made a pretty large amount of money, a little over $100,000 selling silver short in the decline in stock prices. So you can see this relationship, and I hope it's a lesson that you really kind of lock in your mind, because you're going to hear a lot about, oh, buy gold when stocks decline. Well, look, this is reality. This is what really happens, guys and gals. Gold declined when stocks decline. I'd like to give a short-term cycle projection now. This is using daily charts. This is what I see happening on a daily basis. We should start to rally about now, then drift back, and then the larger move begins. So that's a very short-term cycle formation of what I expect to take place in the market. Okay, well, what stocks we're going to buy? Hmm. Well, I don't know what stocks you're interested in, but I'd like to share with you one of my really powerful techniques to find the stocks to buy right here and right now. We're looking at Apple. Notice back here that the Dow Jones Industrial Average, or in this case, the triple Qs are on top because that's the exchange where Apple trades. And the market had been a big sideways pattern, yet Apple had been consistently higher. So Apple was comparatively stronger than the market itself. And no wonder it had such a huge move in the market. Now notice the peak up here. Stocks made new highs, but Apple didn't. Weakness in Apple. And we knew that in advance because it wasn't as strong. It was comparatively weaker than the market. So how about now? Well, they're both dancing the same tune, aren't they? Apple made it a lower low. Triple Q's made a lower low. Same thing. So we don't have any comparative divergence or difference. We don't have anything. So might go up, might go down, but it's not as sure of a thing as perhaps another stock. Now we're looking at Costco. Look at the difference here. Lower lows by a lot in the averages, but not in the price of Costco. It actually made a higher low here than here, which says somebody's come under accumulation. Somebody's started to come in this market and be a buyer. Notice last year we had huge divergence here between here and here, sideways in price, and then we have a nice up move in the marketplace. So we're seeing comparatively more buying or more strength coming into Costco now than the market itself. Bullish. Look at Google. Google's doing exactly the same thing as the market right now. Well, might go up, might go down, but if this was on my selection list, I would say, well, I would rather find a stock that has divergence in it, perhaps like Fastenal. The market's made lower lows here. Fastenal's held up pretty well, especially the last few days. So that's what I'm looking for chart-wise to find markets, individual stocks that should outperform the market. Here's JKHY. It's been a great growth stock. Look how much stronger JKHY is here than the average itself. Lower, lower. We're not lower. We didn't take out the lows back here. The market took out all the lows back here. So much lower here than back here. Thousands of points lower. JKHY held up, which tells us it's comparatively stronger than the market averages. Bullish, really bullish. Well, I hope you've learned a little bit today. If you'd like to learn more, you can go to our website, ireadytrade.com. I do a weekly market commentary. It's almost $30 a month. And we have a stock course as well for specific trading. But I hope you've learned some lessons today. I hope you learned that comparative strength is a really good indicator of telling us what stocks to buy, and that you've learned that what causes market bottoms are panic in the marketplace, a huge amount of selling, a larger expansion of daily ranges. When we start to see that in the market, it gets really, really bullish. And we have to start looking for the best stocks to buy. We can do that by looking at the comparative pattern I've talked about, and then also looking for what cycles are telling us, what the bond market is telling us about when stocks should bottom, what the energy market is telling us, to give us that view of the future. You trade with a view of the future, your trading is going to be much more successful because you have perspective. If you have perspective, as these markets break, you don't lose confidence or courage. You might stay with your good positions, get out of the ones that are comparatively weaker, but it gives you ability to see across the valleys to where the markets are going, as opposed to right here, right now, when everybody is panicking, and they are. It's really hard to live through those times of panic because it seems like you should panic too. The secret to panic, if you're going to panic, do it before everybody else does it. The people that panicked up here are the smart ones. That are people that are panicking down here with large volume, with large range expansion. Well, as we know from the record going all the way back to really the 1900s, all these market bottoms have been made with large expansion of ranges, large volume coming into the marketplace. That's simply how markets top and bottom. So keep that lesson in mind. Remember, you want to look for comparative strength, like the difference we see in Costco. Costco's, the price is so much stronger here than the market, so this market's getting set up to rally. Those are little lessons you can use in the marketplace. I hope you've enjoyed this, and if you want to come trade with me and see my trades, because I actually do trade quite a bit, we show that as well in my weekly commentary at ireallytrade.com. Well, there you go. We have a panic buy signal in effect. The bull market's back, and I'm going to wish all of you good luck and good trading.